Hi, my name is Mahesh Gowande. We are in the first week of July and I'm giving you next quarterly update how to look at the markets and how to invest in the markets. April month gave a slight negative close while May gave the pleasant surprise to the most investors. The June month remained calm and choppy, but volatility kept dropping. At all-time high of 15,915, surprisingly volatility kept dropping, which was a bit, which actually sent a very negative signal in the market, and people were looking at markets to correct big time, but nothing really happened even in the last week of June. What is interesting is in the last 2 months, mid caps and small caps have recovered, and not only recovered, but they have actually crossed the all-time high. So this could be termed as a very secular rally now. We are not only looking at the top 50 going up, but now the market breadths have improved a bit, and we are seeing bullishness across all the stocks. Typically, even the sugar sector, the small caps, the turnaround stories, the metals, every sector is participating, and this is a very good sign of the market. Going back, if you remember in last 2 months, our strategy towards market has been, we kept putting money in pharma and mid cap, small cap, and lastly we invested a little bit of amount in Nifty low alpha ETF. Low alpha ETF, again a very good ETF wherein the names are quite top 50 names and the quality of the company is very good, but they are low beta. So in case markets go down, they tend to fall less. So we are shifting our gear from a very high risk profile to we are moving our funds to a low risk profile. This is what strategy we would like to continue for the next 2 months. What is interesting is infrastructure rally is now picking up. Infrastructure stocks, the frontline stocks have already caught up. They are at all-time high. Look at Siemens, look at L&T. Reliance comes in infrastructure stock as a very highly weighted. It's almost like 20% weight is there in infrastructure ETF. So we are moving some part of it and even shifting that money to low alpha, wherein we would be like protecting our capital. So our current strategy is to move money from a high beta ETF to low beta ETF. We do not see risk at the current levels. Going back last year in 2020, in the month of January, our exposure to equity market was just 15%. The Nifty level was 12,400 and we were 85% in debt market. Today in this current market, when the Nifty is around 15,900, we are 90% invested in equity markets. We are hardly 10% sitting on cash. The reason behind this is risk profile of the market. We were looking at extremely high risk profile in the market. We were looking at market as a very risky levels. At 15,500, we do not see the same amount of risk, and that is why we have kept our positions in the market. So ideally, it should not happen. The confidence and the system is still not giving us any negative signals to the market. In case there is an event that can actually bring the markets down, we will definitely get an opportunity in a pullback to reduce our exposure. Markets do not fall without giving a hint, without giving any signal. So even if markets have to fall, they will give us clear-cut signal. So my request to all the investors, do not worry about the levels. Markets do not look risky at the level of 16,000 or at 15,500. In fact, any dip or any big fall should be looked at as an opportunity to invest more in the market. Going forward with a 3 months view, we would suggest continue investing in low beta ETFs, which is low alpha vol. Again, there is banking sector. Banks look still very attractive. From a 3-year perspective, pharma, or actually more than that pharma, it is healthcare is looking very, very attractive. So once again, I would suggest everyone not to get deterred by the level of Nifty, but look at the risk profile of the market. The risk profile is as good as 12,000 Nifty. So continue investing in stock market. Thank you once again, Mahesh Gowande.